Okay, so no questions. I remind of this matter. So don't forget today is our last day to um, deliver your answers for the midterm test. Okay, don't be late to deliver that. Okay, so I have it upload the names, not deliver your answers. Okay, so please take a note um, before the today finish that. Yeah, if you could if you couldn't do that, so I'm fear that I can't give you the grade. Okay, for the midterm test. All right. Okay, so any questions? Okay, no question. So we start with the next video.
Second set of facts, the time-varying risk premium. When we looked at the first set of graphs last time, we saw that stocks vary tremendously over time. So there's my stock returns. And those look pretty random, don't they? They look sort of like coin flips. They're not, if it's up today, it's sure to be down tomorrow. Notice that if it's up to, there's quite often 2 dots in a row up, 3 dots in a row up, 2 dots in a row down, 3 dots in a row down. It really looks like if it's up today, it's equally likely to be high and low tomorrow. And for many years, that's the way we thought of stocks. The premium is high on average, but it's a random walk. It's unpredictable. And there's a way to tell. This finance is not about taking things for granted. It's about looking hard in the data and seeing how it works. Our method for evaluating, can you tell where the stock market is going? Can you tell if returns will be high or low tomorrow? Is quite simple. We run regressions. So the typical regression is we run tomorrow's stock return or next year's stock return on any signal today. And we've run thousands and thousands of these regressions. So as a way of getting a sense, are stock returns, is there momentum? If stock returns are high, do they keep on being high next year? Or is there profit taking or mean reversion? All these fun things you read about in the newspaper, we can check. We do it by running a regression. So the first set of regressions runs next year's return on this year's return to see if there is predictability in stock returns. And the answer is a devastating no. The coefficient is close to 0. The t-statistic of the coefficient says it's totally insignificant, even if it's there. The r-squared is next to nothing. Stock returns look awfully like coin flips, things that are not predictable over time. Another way of saying the same thing, if we have a regression of this sort, then today's expectation of next year's return is just the right-hand side of that regression. So if the b equals 0, if b equals 0, as we seem to be finding here, the conclusion is that the expected return is constant over time. It doesn't vary. It's big, but doesn't vary. That was the view of the world for many years. But an exciting prod to theory is the new view of the world that, in fact, that is not true. There are variables that forecast stock returns. Let me show you one. This is taken from the discount rates reading. Here's the same regression where in the table we run stock returns next year on this year's dividend price ratio. And look what we get, a coefficient of 3.8. That's a big number, as we've seen. A t-statistic of 2.6, and if you look out 5 years of 3.4, the r-squared, you may not think of those as big, but you soon will. In finance, r-squareds like that are quite big. And I'll show you the other statistics in a moment. This next graph, titled Dividend Yield and Following 7-Year Return, tries to make that regression come alive. The blue line is the dividend yield, dividends divided by prices. It's the opposite of the price-dividend ratio, which tells you something about the overall level of stock prices. Incidentally, it varies all over the place, which is weird. Why should stocks pay high prices relative to dividends in one year and low prices in another year? That's a big question we'll be thinking about. For the moment, notice the dividend yield varies tremendously over time. That's the blue line. The red line graphs what is the 7-year return from that year going forward. So the red line stops here because I don't know the 7-year returns for the following years. Well, the picture of the graph is pretty devastating. If you buy stocks in like 1980, when prices are low, dividend yields are high, you get a very good return afterwards. If you bought stocks in 2000, when prices are high, dividends are low, you get rotten yields afterwards. And that correlation is very strong. This graph is simply illustrating the regression. I have the 5-year regression up there. That illustrates a 7-year regression. And you can see the correlation between dividend yields and subsequent long horizon returns is very strong. What do we learn from that fact? What we learn from that fact is that expected returns, the fitted value of this regression, do move substantially over time. R squared is in fact not a very good statistic for that. A better statistic for that is just how much do expected returns vary over time. So that's what the number up here in the table, 5.46, tells you the variation of expected returns. So look at what that regression is now telling us. It's telling us that expected returns vary by 5.4% over time. This little picture here is designed to get you a sense of what's going on. The average return is 7%. That was big. The actual return varies a lot, 16% to 18% standard deviation. What we're learning is that the expected return goes up and down, and it goes up and down a lot, 5.6%. It goes up and down almost by the size of the actual return. So expected returns, risk premiums, are big, and they vary a lot over time. Why? We're here to look at economics, and you can start to see some economics. Here's what happened in the 1970s when stock returns, when all of a sudden expected returns got really high and stock prices got really low. The economy was terrible. Gee, what happened in 2008 when the dividend price ratio again signaled high expected returns? The economy was terrible. So what we sniff here is that in bad times, people are unwilling to bear risk. But we need to make that into a model. We need to see if that actually works. Next question. Let's go back to the issue, why do prices vary so much? What we're really seeing in this graph and the dividend price ratio is that prices are going up and down so much. Well, you might say, why are prices high? Prices are high relative to current dividends because everybody thinks there's going to be good growth and dividends will be high in the future. That's what you might have thought before you looked at the data. This next table, which is from the financial markets and the real economy reading, contrasts what happens when you try to forecast returns with what happens when you try to forecast dividend growth. You might have said high prices mean that dividend growth will be high in the future. Look at the numbers. 0.7 minus 0.42, 16, no t statistic, no r squared. Compared to the numbers for returns, 4, 7, 9, 12, 6, and 20 with big T statistics. If you said prices are high because everyone expects high future growth, you would be exactly wrong. Prices are high because you expect low future returns. This next graph kind of illustrates the idea. The classic view is what you might have thought. Here I graphed a low price. If prices are low relative to current dividends, people would have said, well, that's because dividends are going to fall over time. In fact, that's wrong. If prices are low relative to current dividends, that means prices will indeed bounce back to some extent over 5 to 7 years, and you will earn a good return. That's a rather astounding fact. It is pervasive throughout finance. I showed you stocks. We'll look at it in stocks, bonds, foreign exchange. Everywhere you look, high prices correspond to low subsequent returns and are typically seen in business cycle times when people are willing to take risk. Low prices correspond to high returns and are typically seen in times of the business cycle when people are unwilling to take risk. This graph shows house prices and rent. Houses behave the same way. No surprise, in the early 2000s, prices were high relative to rents. Did that signal that rents would increase in the future? No. That signaled that, how can I put this politely, returns were going to be low for a few years, and that is in fact how it worked out. So let me summarize what we've learned here. We've looked at the variation of the risk premium over time. First, we learned the risk premium was big. Now we want to know, is it the same over time? What we've learned is price-dividend ratio forecast returns. That's one example of many, many variables that forecast returns. Therefore, from last time we learned expected returns are big. Now we learn that expected returns vary a lot over time. They're big in recessions. They're big in bad economic times. We've learned that this phenomenon is so big it changes our view of the world 100%. Price-dividend ratios don't, in fact, forecast dividend growth. Price-dividend ratios forecast returns, and that entirely changes where you think the variation in prices come from, which we still need to account for quantitatively. When we're going forward to theories, our basic theory will be price equals expected discounted dividend growth. Learning that risk premiums vary a lot over time teaches us that this discount rate will have to vary a lot over time, and that'll make our theory very, very interesting. So that's our second big set of facts. I hope you're really dying to get to the theory.
Okay, so the time varying risk premium. Okay, so this time varying okay risk premium. So that means the change over time and the influence of the premium. Okay, so next video we let's introduce the premium by the cross-sectional. Okay, cross-sectional, the many kinds, the different risk. Okay, so you can compare that to time varying risk premium. Okay.
So now our third set of facts, the cross-section of stock returns. Are there some kind of stocks that do better than other kind of stocks? If so, what are they and why do they do so? Let's look at the facts again. So I start with a graph. These are portfolios of stocks formed on the basis of size, market capitalization, and also portfolio of bonds. So the little triangles off on the right, those are 10 portfolios of stocks. The small stocks are off on the right, and the big stocks are on the left. For reference, I have three kinds of bonds here: treasury bills, long-term government, and long-term corporate bonds. The axes, well, the vertical axis, let's start with, is the average return. And that average return axis answers our first question. Are there some kinds of stocks that pay returns over long periods of time? This isn't just luck, that pay returns more than other kinds of stocks. Answer, yes, and big time. Notice that the big stocks are paying about 7 to 8% return. The small stocks are paying 17% return. Wow, why don't I just put all my money in small stocks? Well, again, what we're looking for is an economic explanation. Our job is to throw water on all your investment ideas and to understand why that could persist over 50, 60 years. What is the kind of risk in small stocks that are making people afraid of small stocks? The model for risk, the generic model, is the capital asset pricing model, which of course we're going to study and derive and think about. But here is the capital asset pricing model. It says expected returns on one stock versus another stock, should be proportional to beta. Beta is the regression coefficient of each stock on the market return. So the way the world should work, according to this theory, is if we put expected returns on the vertical axis and betas on the horizontal axis, that the stocks with higher average return should have higher beta. They should, when the market goes up and down, they should go up and down more. And that's a fairly simple concept to see. Small stocks don't give you any premium over big stocks if they act just like 2 times big stocks, if you can get the same thing by borrowing money and investing in the big stocks. And that's roughly the way the capital asset pricing model works. So what do you see in our top left graph? You see that for small stocks, yes, there is huge variation across stocks in the kinds of returns you get, but this traditional capital asset pricing model explains that variation quite well. The higher stocks are only earning returns in proportion to their beta. You can synthesize those same returns by just leveraging up a market index. It's not a great investment opportunity. Too bad. Sounded like fun. As with our investigation of the time series, though, the better telescopes have changed the facts dramatically. And that's a set of facts for us to keep in mind as we're developing theories. Here's a graphical version of the value effect, the most central of these new findings from the discount rate paper. On the x-axis here, I've sorted stocks into 10 portfolios. So the value portfolio consists of those stocks with the lowest prices compared to the book value. The growth stocks contain stocks with the highest prices relative to book value. The value stocks are things like airlines, steel mills, railroads, things with a lot of book assets and not much stock market value. The growth stocks are things like Google, huge stock market value, practically no assets to look around and see. So which one do you want to invest in? I could make that a little quiz. Well, let's look at the facts. What are the returns? That's the blue line. So is there a difference in average return as you go from growth to value? Yes, and it's enormous. We practically double the returns, and interestingly, it's the value stocks that are in the big returns. That's called the good stock versus good company fallacy. Great companies with lots of profits, the stock market knows about it already, and those prices are already high. Too late for you, so that the return to stockholders is actually better taking on the value stocks. Well, that's not surprising, you say. Value stocks are riskier. But look at the beta lines. The beta lines are exactly the same. This was a big, big anomaly, a big puzzle. How is it that the value stocks earn higher returns and don't pay higher betas? The answer is multi-factor models, which is how we now understand betas. Pham and French introduced a 3-factor model, a version of the capital asset pricing model with more factors. Yes, there's the market return, but there are also regression coefficients on a new factor of value minus growth stocks, HML, and another new factor, small minus big stocks, SMB. One paper we're going to read carefully this quarter is Pham and French's paper on value effects. So they like to put these facts in tables of numbers, and their table 1A gives you a similar table of numbers. What we've got here is stocks sorted into 25 portfolios based on size and book to market. So the small stocks go that way, and the value stocks go in that direction. So question 1, is there a variation in average return between those categories? Yes, huge. 0.37% per month here, 1.08% per month there. A factor of 3. You get 3 times better return up here than you do down there. Wow. Investment opportunity? Well, let's look first and see if there's risk. Turns out there's no capital asset pricing model risk. The betas are all the same. But Fama and French tell us that they explain these phenomena with Table 1, Part 2, the three-factor model, regressions of return on market, SMB, and HML. And the salient fact from this table is that if we look at these B, S, and H coefficients, the S coefficients rise in that direction. The H coefficients rise in the other direction. Therefore, say Fama and French, we explain the large expected returns. High expected returns correspond to those high B's and H's. That's a deep fact for us to meditate on. Now, let's meditate a little bit. Where do these models come from? We need to see, how do Fama and French get to call that an explanation? Why are expected returns so high for value stocks and for small stocks? These, quote, explanations, unquote, put the market, HML, and SMB on the right side. So even if these models work, we have to ask ourselves, why does the market pay such a return? Why does the HML portfolio pay such a return? Why does the SMB portfolio pay such a great return? So why is the HML portfolio, why does that portfolio generate a risk premium? Fama and French have a story for that. It's highlighted on page 77. Why is relative distress, HML, a state variable of special hedging to concern to investors? A possible explanation is human capital. So they tell a story here that people are worried about their jobs falling apart at the same time as HML falls apart. They're making an economic connection to try to have the economic underpinnings of those models. Third question we have to ask ourselves, Fama and French call this not just a model of expected returns, they call it a model of returns. There's a factor structure. All the stock returns are correlated with each other. When you read their first paper, they say this is a model of returns and expected returns. What do we know about the factor structure in stock returns out of this paper? That's our set of cross-sectional facts. Like the time series facts, our facts are exploding. Big quick summary, there is strong variation across different kinds of stocks in the expected returns, the risk premiums that they pay. Strong variations also in currencies, bonds, all sorts of different assets. Yes, indeed, you can earn a high risk premium in some and low risk premium in another. The way we explain these things is with factor models of this sort, where expected returns are supposed to only depend on some regression coefficient. We'll have to learn about those models, and we'll have to try to understand the economic fundamentals of where those models and where those risk premia come from.
Okay, so you develop model. You develop model. So from the cross-sectional data. Okay, so we can create the model with the three factor. Okay, so three factor. So the factor structure. So the expected return can be decided by three factors. Okay. In other words, we can use the three factors to explain how the expected return variation. Okay, so first factor is market factor. Okay, the beta. Okay, and beta 1, and the second factor is SMB. Okay, so this is size factor. SMB stands for the size. Okay, and last factor is HML. Okay, so maybe then the distress, financial distress. Okay. Okay. Compare the equation to the traditional capital model. So we know the traditional capital model explain that expected return determined by one factor. Okay, the factor is beta 1. Okay, yeah. So then they don't need two additional the factor SMB and HM0 to expand the expected return. Okay, they just need the one factor beta. Okay, so why we extend and develop the three factor models? So because we want to expand the phenomenon the equity premium is so large. Okay, so we need more risk factor to explain why we have so large the risk premium. Okay, yeah. So this. Okay, so if you find you use the three factor model to explain the risk premium is not enough, so you can extend and include more risk factors in your model. Maybe you can construct multi-factors the model to explain the risk premium. Yeah. Okay. So by APT, arbitrage pricing theory, they can provide the multi-factors the model to explain the why the equity premium is so large. Okay. Any question?